Hello, my name is Andy Berry, Vice President of Logistics with Stutsman. Thanks for tuning in to our fourth edition of the Transportation Market Update. This episode, we're going to be focusing on load-to-truck ratios, market demand, and how that's impacting spot rates. We're also, for the first time, going to take a look at futurecast. What are the rates going to look like 6 months from now, 12 months from now, and how that's changed and how that forecast has actually morphed over the course of the last year. We're also going to take a quick look at tariffs. What's the impact on demand? And more importantly, what's the impact going to be on supply over the long term if these tariffs stay in effect? The first metric that we have continually highlighted for you is load-to-truck ratios. A significant change year over year as you look at last week. Load volumes were up 21% year over year, which drove the load-to-truck ratio up 14%, which should put a little bit of constraint or a little bit of stress on your supply chain. Ultimately, it's believed that most of the increase in demand is due to the onset or the threat of an onset of tariffs and a lot of organizations trying to bring in additional goods in order to beat the onset of those new tariffs. Confirming the DAT analytics that we just looked at on the load-to-truck ratio, we have found that the FTR intelligence is also reporting that dry van spot load tenders and dry van spot rates are also increasing. This data is dated a week older than what we saw from the load-to-truck ratio, so we expect to see quite the spike. But as you can see, dry van spot loads are continuing to increase, which will put continued pressure on the spot market and increased rates over that time as well. Expect to see an increased spike once again as the tariff pressures and the uncertainty in the marketplace continues to drive demand, which is up year over year, as well as increased pressure on your spot rates. Moving into what's going to happen with our spot rates from a long-term perspective. This is something that we haven't highlighted in the past, and quite frankly, it's because there's a tremendous amount of uncertainty in the marketplace. And as you'll see here, based off of the information and the visuals that you'll see, no one really knows what's going to happen. For the first time, we're going to review the model for predictive truckload dry van spot pricing provided by Morgan Stanley. This model reviews truckload pricing in the spot market, looks at where the benchmark rate is today, what a 6-month look will produce, as well as then a full 12-month forecast. As you can see, the model changes and has been in flux over the course of the last year, highlighting a really volatile market. In July last year, the benchmark spot market rate was $1.61 per mile, with a 6-month projection of $1.91 and highlighting that a 12-month forecast of $2.12. In November, the same model, which theoretically should have been around a benchmark of $1.91, was still only at $1.63, so very light increase in total rate. And then their forecast in November was $1.83 a mile for 6 months and $2.04 a mile for a year out. Obviously dropping from the forecast they had earlier in July by nearly 8 cents when they looked a year out. In February, we looked at the same information, and the baseline then still was $1.61. At one point was going to be forecast near $2 a mile. So rates had actually declined from November to February by 2 cents a mile in the spot market. The 6-month forecast being $1.75 and the 12-month forecast up to now $1.94. Once again, in just a few short months, they had dropped the 12-month forecast, in this case by a full dime. Highlighting the volatility of the market, the uncertainty of things to come. We looked at the same data last week, so actually it came out just a day ago. And according to this data, the baseline information was now at $1.60 for spot rates. The 6-month forecast was still at $1.76, and the 12-month forecast has now dropped to $1.89, highlighting the fact that the uncertainty in our marketplace has continued to push a flattening in what their forecast looks like. I can tell you that in the third quarter of last year, I felt fairly certain that we would see a fairly robust recovery in the market, which would mean that more demand and a probability of less supply. Now, which would mean, of course, higher rates and higher costs from a transportation perspective. With the uncertainty, a very light blip in demand due to the tariff situation, we just haven't seen the increases that we expected to see. And now most experts are even though this is still looking at a 29-cent increase by the end of the year, a lot of experts are calling for just a 1 to 2% increase in contract rates. Now, that's contract rates year over year, and then that 20% increase in spot rates. So the volatility we just discussed, what drives that? And quite frankly, it's probably the elephant in the room, tariffs. What's going to happen with tariffs, and what's going to be the impact on your supply chain, your costs, and eventually the transportation industry? From a demand perspective, the initial impact can be felt very quickly, within weeks of the initial tariffs going into effect. You look at perishable goods that come in and out of the country, the impact on reefer loads and refrigerated freight around the country, which will trickle down into other modes of transportation. So you would expect to see a softening of demand over the course of the first few months as it relates to consumable goods or perishable goods. When you look at other consumables, there's an estimate that a lot of those consumables will demand will start to decrease over 3 to 6 months. When that impact is felt, demand will fall even further. And that's when we will really start to see the impact on the supply side or the capacity side of our market. The impact of a short-term tariff can be absorbed rather well in the transportation industry. It is when you get into the long-term impact is where it really starts to impact the supply side or the capacity side of the industry. Tariffs that are longer than 6 months, or tariffs that are felt and sustained by our larger trading partners for an extended period of time, will continue to have a tremendous impact on the number of carriers that would exit the market due to a lack of demand. The prolonged period of lower demand by a larger trading partner would absolutely continue to decrease that demand to where it would drive out many of our smaller transportation providers, and could be a large impact on the available capacity that's out there, which will absolutely impact the cost of transportation and your rates in the future. This being early April, if we do see those tariffs sustained for a long period of time, I would suspect by the end of the year, we could have a tremendous change in the cost structure of your transportation moving forward. In past episodes, we've discussed the classic truckload cycle and where we believed we were at in that cycle. I believe early in January, I had indicated that possibly we were in the bottoming of that phase. If you were to look at it, maybe a 6 or a 6:30 timeline on the cycle. Well, the impact of the volatility that we just discussed, tariffs and what's going to happen there, could actually reverse the trend that we had seen. Instead of going in a clockwise fashion and moving into the next phase of the cycle, a recovery cycle for the transportation industry, we are looking at going backwards. A backward phase due to demand decreases, and then some possible continued heightened supply challenges as well. Now, the discussion on tariffs and the fact that if those tariffs could last an extended period of time, more than 6 months, so we will gradually fall backwards. But if those tariffs last a long time, we would accelerate that recovery from a transportation perspective even quicker. So we could advance to a situation where we are almost mid-cycle by the end of the year, which again, for your cost perspective and your transportation spend would be a drastic increase. From a transportation perspective, they would expect to see a much higher yield for their transportation efforts. Our discussion today certainly has highlighted the volatility that's taking place right now in the marketplace, the uncertainty, the challenges that we face, and what it could mean to your supply chain capacity. At the end of the day, you want to make sure and align yourself with high quality, sustainable business partners that you know will be there for you through these challenging times. Well, at Stutsman's, we have 90 years of history to show that we value our partners, the relationships we have, and we are going to be here to make sure and serve for your success.